either hoarding too much cash in your bank account or not keeping enough for emergencies. Imagine standing in front of a buffet. Each dish represents a different aspect of your financial life. One dish, quite crucial, is your cash liquidity. This is the ready cash you have available to immediately cover both expected and unexpected expenses. It's your financial safety net, ensuring that you're prepared for life's unpredictable turns without the need to liquidate other investments at a loss. Now, why is liquidity so important? Simply put, it's about having the flexibility and security to address needs as they arise. Whether it's a sudden car repair, an unexpected medical bill, or even a spontaneous opportunity for investment, having accessible cash can be a game changer. However, there's a common misconception that more cash in the bank means more security. This isn't always the case. Excess cash could actually be a silent culprit, eroding your wealth due to inflation over time. On the flip side, too little may lead to unnecessary debt or financial stress in crisis situations. The art of personal finance is not just in making money, but also in managing it wisely. It's about understanding how much cash is too much, which could be stagnating instead of growing, and how little is too little, which might put you at risk. Striking the right balance is key, and that's what we're here to figure out. First off, let's clarify what liquidity really means in the context of your personal finances. Liquidity, in the simplest terms, is the ease with which you can convert your assets into cash without losing value. This concept is absolutely crucial when it comes to managing your everyday financial operations. It ensures that you have the funds available to cover both expected and unexpected expenses. Imagine you suddenly need to repair your car or an unexpected medical bill comes your way. If your assets are highly liquid like the funds in your checking account, you can handle these expenses swiftly. On the other hand, if your money is tied up in investments like real estate or stocks, which can take time to sell and might not retain their full value, you could be in a pinch. Having liquid assets means being prepared for life's surprises. It's about balancing between having enough cash on hand for emergencies, while also investing for future growth. Keep in mind, liquidity is about having access to your money when you need it most. Now, how does an emergency fund fit into this liquid puzzle? Imagine this. Your car suddenly breaks down, or perhaps there's an unexpected medical bill. Scenarios like these are precisely why an emergency fund is critical. It acts as a financial buffer that keeps you afloat during sudden crises without having to rely on credit cards or loans, which might put you deeper into debt. The primary purpose of an emergency fund is to cover necessary expenses in times of financial distress. Whether it's a job loss, unforeseen medical expenses, or urgent home repairs, having this fund ensures that you can manage these without panic. Think of it as your financial shock absorber, cushioning the blow from life's unexpected punches. Now, onto a burning question: how much should one actually keep in this all-important fund? Financial advisors commonly suggest that a robust emergency fund should cover 3 to 6 months' worth of living expenses. This range isn't arbitrary. It's designed to give you enough time to perhaps find new employment or adjust to any new financial circumstances. For someone with a less stable job or single income source, leaning towards the 6-month mark offers extra security. Moreover, this fund should be easily accessible. You don't want your money tied up in investments that take days or weeks to liquidate when you need funds immediately. High-yield savings accounts or money market accounts are typically recommended for their combination of accessibility and interest-earning potential. An emergency fund isn't just a safety net, it's your financial stress reliever. Apart from emergencies, everyday expenses and future goals also dictate how much cash you should keep. When considering the cash to keep on hand, start with the basics. Monthly expenses. These are your non-negotiables. Rent or mortgage payments often top the list, consuming a significant chunk of the budget. Utilities follow: electricity, water, and gas, essentials that keep your home running smoothly. And let's not forget about groceries. Eating is a necessity, but the amount spent can vary widely depending on family size and dietary preferences. But managing daily expenses is only part of the equation. Financial goals play a crucial role too. These goals can be short-term or long-term, and each type influences your liquidity needs differently. Short-term goals might include saving for a vacation, buying a new gadget, or preparing for the holiday season. These are typically goals you aim to achieve within a year. Because they are upcoming expenses, having a liquid fund that you can dip into without penalty is critical. This ensures that you meet your goals without disrupting your financial stability. On the other hand, Long-term financial goals require a different approach. These could be saving for a child's education, purchasing a home, or planning for retirement. Such ambitions are not immediate, but they demand consistent saving. For these, you might look beyond just keeping cash in the bank. Investing in stocks, bonds, or mutual funds could be a more effective way to grow your wealth over time, while keeping a portion of your assets liquid for unexpected needs. Balancing between enough cash for daily needs and investing for future goals is a delicate dance. It requires understanding your current financial situation, your risk tolerance, and your time horizon for each goal. To manage this effectively, consider creating a budget that outlines your expenses and goals. This will help you visualize where your money is going and how much you should ideally keep liquid. Remember, the right balance will help you not only cover your expenses comfortably, but also move confidently towards your financial aspirations. Plan your liquidity to not just survive, but thrive. Everyone's financial situation is unique, which means your ideal cash reserve will be too. Determining the right amount of cash to keep on hand isn't just about picking a number out of the air. It's about understanding personal factors that influence your financial security and liquidity. Let's delve into some of these critical factors, starting with job stability. If your job situation is precarious or you're in a field with high turnover, it's wise to have a larger cash reserve. This provides a buffer if you find yourself in between jobs. Next, consider your monthly income. Those with a steady, predictable income might not need as substantial a cash reserve as someone whose income fluctuates, such as freelancers or commission-based workers. For the latter, a larger cash reserve acts as a stabilizing force, smoothing out the financial highs and lows throughout the year. Personal risk tolerance is another crucial factor. Some people might feel more comfortable with a year's worth of expenses saved up, while others might be content with just 3 to 6 months. Your risk tolerance might be influenced by factors like financial responsibilities, whether you have dependents, or your personal comfort level with uncertainty. The decision of how much money to keep liquid also depends on your lifestyle and financial goals. If you're planning a major purchase soon, such as a home or a car, you might want to increase your cash reserves in anticipation. Conversely, if you're someone who values investment and growth, you might choose to keep less cash on hand to allow more funds to work for you in the market. In essence, the question isn't just how much cash you should keep, but how these personal and financial circumstances shape your approach to liquidity. Each person's balance between security and opportunity is different, and your cash reserves should reflect that delicate balance. Consider what makes your financial situation unique when deciding on your cash reserves. Managing your bank balances doesn't have to be a juggling act. Let's dive into some practical tools and strategies that can streamline the process, ensuring your liquidity is not only maintained, but optimized. First up, budgeting apps. These handy tools have revolutionized the way we manage money. By providing a clear view of incoming and outgoing funds, budgeting apps help you keep a tight rein on your finances. They categorize your spending, track your savings goals, and some even offer alerts when you're nearing your budget limit. This real-time feedback is crucial for staying on track with your financial goals. Next, consider setting up automatic savings plans. This is a fantastic strategy for those who find it hard to put money aside. By automating your savings, a predetermined amount is transferred from your checking to your savings account each month. It's a set-it-and-forget-it method that builds your savings effortlessly, ensuring that a portion of every paycheck is saved before you have a chance to spend it. Now, let's talk adjustments. Your financial landscape is bound to change, and your approach to managing liquidity should adapt accordingly. Regularly review your financial goals and current situation. Perhaps a career change, a new family member, or even an unexpected financial windfall. Each scenario might require a different liquidity strategy. Adjust your budget and savings plans to reflect these changes, ensuring your financial base remains solid. Equip yourself with the right tools and watch your financial confidence grow. By embracing these strategies, you're not just managing your money, you're mastering it. Congratulations! You're now better equipped to tailor your bank balances to your life's rhythms. As we've explored today, striking the perfect balance in your bank account isn't just about numbers. It's about aligning your financial resources with your daily needs and long-term ambitions. Ensuring the right level of liquidity is crucial for both immediate security and future growth. Remember, smart financial planning is the best path to a stress-free financial future. Subscribe to Rise Uplift Your Finance for more insights. See you next time.